All right. Well, thank you for joining me today, Aurora. With what's been going on in really the state of California with the horrific fires, Aurora and myself have withheld really sharing information or facts as we see a lot of misinformation going on out there with our clients, with the community, with news stations, even with other licensed agents. There's just been a lot of information that has been going around, and in our opinion, a lot of not correct information. So we wanted to wait and get all the facts straight to make sure that we were delivering correct information to our clients, so we weren't stirring the pot or adding to anxiety for all the public and community here that's dealing with these horrific fires in California. So thanks for joining Aurora here, and we look forward to just having a little chat here and trying to um, dispel some of the things going on and provide some value to our clients, community, referral partners, and anyone else that might watch this and hopefully learn something from it. So I just want to dive in, ask Aurora, ask you a few questions here, and really try to get some correct information out there for the public to garner. So one of the things that we get asked a lot is, what steps should a client take if they had a total loss in a wildfire? We're seeing obviously a lot of structures burn in the fires that are going in the LA area right now. What are some good tips or information that a client should be doing right away?
Yep. The first thing I say is always reach out to your agent. The reason that we work with you on that is that we're going to have a quicker entryway into the claims process than you would if you try to sit on the phone. So most of the carriers in today's world, we have an online capability. We have all of your policy information. We have everything. We'll collect what your current best contact information is so that we can really streamline the start of that claims process for you. A lot of times people will try to call in, they don't have their policy number. All of those things can hold up, and especially in these huge fires like this, when you've got almost 3,000 individuals that are in the same situation as you. The longer you wait to start the claim, the longer you wait till you start to see some of the immediate benefits that are out there for you.
Absolutely. And I know right now, especially in catastrophic situations like what we're seeing right now, a lot of carriers step up to the plate to try to speed that process, disperse funds, get money in the hands of the clients sooner than later, because obviously they're at a total loss at this point, and even basic money for basic needs are extremely important to get in the hands of the consumers at this point in time. So we're seeing that play out right now with the carriers, correct?
We are, yeah. So there are wildfire protection laws that are in place in California that state that regardless of who you're insured with, they have to give you at least 30% of your personal property coverage without you having to itemize it. So that's pretty much a chunk of money that you're going to get immediately to go rebuy necessary items for your family. The other item that you're going to get is 4 months worth of what is called loss of use or fair rental value. So that is basically the funds that you're going to get to be able to go and find another residence, part-time home, anything that you need to be able to get some stability back in your life as soon as possible after these events. So those are immediate things on there. Some carriers, this is where it becomes carrier by carrier. Some
Hmm.
carriers will go above those wildfire protection laws. Some will stay right within that realm. So you really have to talk to the adjuster to see what they're going to plan to do. But a lot of these carriers are not only going to have the claims process, but they set up different locations in these areas where they have trailers or they have locations that you can actually walk up and you can get a lot of those checks cut on site for you. And I think that's something that doesn't get shared enough out there. And that's something that your agent is also going to have access to be able to communicate that with you, that you can go there on this date if you haven't heard from an adjuster by that time.
Yeah, no, that's absolutely correct. And expediting the process anyway is so important during these times. So that's great. So another thing that's kind of leads us into the next conversation, which I see all over social media. I know our agency, we've gotten a lot of calls on this from clients, just concerned on their current policies, even if they're not in the devastated areas. But what are the consumer protections that are put in place for the consumers in regards to insurance company payouts? Because I know right now there's a lot of misinformation that carriers are just denying claims left and right, and these carriers are not wanting to pay. So it's leaving a lot of consumers like we have that are like in Northern California thinking, is my insurance even good? Is it going to even pay if it was happening? So there's a lot of angst out there right now regarding that. So, what consumer protections are in place, Aurora?
It depends on what type of insurance policy that you're dealing with. If we're talking about an admitted market being like State Farm or Farmers, if they run out of money, then there is what is called the California Insurance Guarantee Association that will step in, and that limit is currently set at 500,000 per loss, which you would say that's probably not going to help a whole lot of people. Now, what we have seen before when the Paradise Fire happened is that they actually stepped in and said, no, we're going to actually increase that to 500,000 per line item. So 500,000 per dwelling, 500,000 for personal property.
Hmm.
So that does give some extension. But again, that's the worst case if it creates one of these companies to become insolvent. Otherwise, those insurance companies have insurance companies. So if they don't have enough money, they have an insurance pocket of money that they can go to from their insurance company that can help relieve some of that stress and make those payouts happen. If we're talking about California Fair Plan, which seems to
Hmm.
be the most concern right now, there are several mechanisms in place. So you have all of the reserve funds that California Fair Plan will have. And then you have their reinsurance funds that go into play. If that still is not enough, then they are able to go to the carriers in California, any insurance carrier that has a property based business here. So if they have any homeowners, it's going to look back for the last 2 years to see what their concentration of risk was in California. So if State Farm had 25% of the property business in California, if they had to assess the insurance companies to back those claims, then 25% of that assessment would go to State Farm, maybe 17% goes to Farmers, and so on. So you have all the member companies that have been in business here in California for the last 2 years, not just today. And a lot of people have said, well, the insurance companies all left, so who's going to be left to pay? And it is not what their market share is today. It is a look back up for the last 2 years of what that was. So that does give you even more of that financial backing. Now, let's say that assessment is not enough. This continues to happen and that assessment is not enough. Then there is the wildfire, basically catastrophic modeling that they put in that says that they can go to the state and get bonds to then also back those. At this time, as it looks right now, these two fires, Palisades and Easton, doesn't appear that it's going to cause an assessment. There appears to be enough of the frontward safeguards to keep that from happening. But if assessment does need to happen, they have 30 days to assess. So there shouldn't be much of a break in claims if it gets to that point. The last type of company we have out there is the non-admitted companies.
Hmm.
Many people hear about this, kind of the wild west of insurance. They are not backed by the California Insurance Guarantee Association like an admitted. They're not backed by the admitted companies. So you're really looking at what their financial stability is to be able to pay those claims. Right now, all of them are saying they are fine. They are not in danger of having any issues like that. But there is essentially built into that if they go out of business and they don't pay claims, there is some risk for consumers at that point because there is nothing backing them other than their own financial protections.
Absolutely. So, just to reiterate, because I know the FAIR plan, which you highlighted right there, is the one that I see most talked about on the social media platforms. It's the hot button in the news right now because it's just covering such a large part of California. There's multiple, I wouldn't want to call them safeguards, but I guess safeguards in place that diversifies that risk, not only amongst the reinsurer and the FAIR plan premiums they get and the reinsurance, but also the shared risk of all the property companies in California too. So really to see a catastrophic failure there, it would be really a collapse of the entire insurance market at that place, right? At that point, with all carriers included, correct?
Definitely lead to more of a Florida based where instead of where we have pockets where insurance companies will offer, a lot of them may just exodus for a while. And we may see that anyway, right? We do know
Yeah,
that there are some insurance companies that have already put a halt to any new business in California, and more are adding that or getting more conservative in what they're willing to take on. So if it gets really bad financially, of course, like any profit company, they're going to have to look at whether or not they can sustain. And that's not only for their good, but that's for your good. Because as we saw with Merced Mutual and Paradise, you
hmm,
never want to have a company who saturates their business knowing that they don't have the funds to back it. So a company that is coming and saying like we recognize that there might be a problem, they really are, whether it seems like it or not, doing what's best for all consumers and themselves to make sure that they don't end up in a situation where you don't have any coverage.
And that's where we've seen really the shuffling the last few years of their books, their saturations was all to protect and put safeguards in place for these exact kind of moments right here. So right now, as it stands, I know no one has a crystal ball, but you just brought up Merced. I know that's just a hot button for people that experience a Paradise Fire or up in this area. Um, right now, we're not seeing any concerns from any admitted or non-admitted carriers currently. Right now, again, we don't have a crystal ball, but really no major red flags are raised at this point. Is that correct?
That's correct. At this point, the communication out there is that everybody has enough in their backing to satisfy these larger claims that we're looking at with with the Palisades and the Eaton fire. There, of course, every fire that pops up, right, that puts more and more strain on this. So maybe we don't see an assessment from Fair Plan for Palisades or Eaton, but some of these newer fires may cause an assessment. And that's the one thing about this mechanism, it's not like a per year basis, right? The insurance companies will get assessed each and every time there is a claim that happens if there is no funds. So there is that, at least that portion of it, that you can rest assured that will continue down that mechanism of protection.
Yeah. And I know, I mean, we welcome it with our clients, but anyone that has questions on their policy, whether in the affected area or not, always a good first step is to call your broker, your agency, and just go over the coverage. It's a no better time than now to review your coverages to make sure that it's in line with your risk tolerance, your needs, that you're properly protected. I mean, as you and I know, we've seen some stuff written out there where people probably are a little underinsured in some instances. So it's good just to know what you have and what you're covered for. And I know we've been fielding a lot of those calls over these last, 4 or 5 weeks, especially from our clients. So would you highly recommend that as well?
Yes, it's always a great time to look at it. And the biggest concern that we see is people are really price sensitive as it sits,
Hmm.
and a lot of them can't withstand any more pressure on that price point. And so they'll go and do something in their house, like change out the kitchen or do new flooring or add an addition. And their mind says, well, I'm already paying so much for insurance. I don't want to call and like put myself on the radar. I don't want to be changes
Yeah.
because what if I have a preferred company now and if I make a change, maybe they'll be like, oh, I don't know why we have this customer. Let's cancel them. And that's not the
Yep.
process of how it works. If they're going to cancel you, it's not going to be because you made an addition to your home, right? So the addition to your home is you want to make sure if you just forked out 50,000 for that, if you have a loss tomorrow, you always want to make sure that your home is insured to value to not only make sure that the mechanisms of your policy contract pay out, but also so that you are reimbursed for all that money you put out there with those changes.
Absolutely. And to reiterate, because I've seen this so many times on social media platforms, and I've actually seen some people that I know are licensed agents talking about a lot of the carriers are just going to start pulling fire coverage from all their policies, even active policies that are in place. So I've had a number, including family members, ask me that question, like, "Is my policy not cover fire insurance anymore or fires?" That is a false statement, and we can rest assured that you're more than your policy does cover that. If it was in place to cover it, they're not going to pull the rug out from under you just because they want to at this point, or not saying they want to, but that they would. Perfect. Lastly, then, when they go through the claims, if they decide that they don't want to rebuild, what steps can they take, or how can they go that process if they didn't want to rebuild?
There's really three mechanisms that are in place. Again, this is part of the wildfire protection laws that have come up. Um, there's the first method that says, I'm not going to rebuild, I'm not going to rebuy, maybe I'm just going to buy an RV
Hmm.
and go travel the United States, right? These policies that you're in are what's called replacement cost policies. So to get the maximum benefit of your policy, the mechanism is that you're going to rebuild that home. So if you choose not to rebuild that home, then what they're going to do is give you a depreciated value from that replacement cost of your home. And you can basically take that money, pay off your mortgage, collect all the other benefits of your policy, like your personal property coverage, all of those things. and then take it and do whatever you want with it, right? But that's going to be the least amount of value that you're going to get from your insurance policy. The second mechanism is that you're not going to rebuild, but maybe you want to rebuy somewhere. So under these insurance protections right now, you now have the ability to say, if you're going to go buy somewhere in a like quality, kind, size, region home, right? So if the average cost for, a home in Malibu is 2.2 million and you decide, well, I can't afford that. I'm never going to do this. This is generational home. And now I'm going to go buy a home in Folsom, but you've got Malibu coverage and you're going to go buy a home in Folsom, you're only going to get to the value that allows you to replace and get you back to whole. So if you can buy that replacement home for 900,000, but you have 2 million in coverage, you may not get all of that 2 million because you are bringing yourself back whole, but they're not going to give you something better than what you had before. So you have that ability where a lot of those policy coverages, including your extended dwelling coverage. So a lot of people will see that because of closing costs, because of interest rates, all of those things to make it work. They will use some of that extended dwelling coverage for that process of building the home. And then the third one is that basically you're going to rebuild, right? You're going to stick around and you're going to rebuild and you're going to go through, in most cases with the total loss, they're going to pay all that out. It's going to go to your mortgage company because most of you have mortgages, and there is a mortgagee clause that states that that money is going to be given to the lender. The lender is then going to work with you and a contractor, and you're going to walk through the process of rebuilding, however long that takes, from anywhere from 1 year to 5 years.
Yeah. We saw a lot of that play out in the Paradise fires. Obviously, people were going through. We saw the whole spectrum of optionality there, but you do have options, but just be prepared that the coverages might vary at that point, then depending on what you choose to do. So that's an important note and something to understand and know before making those decisions how it's going to play out for you. But the good thing is there is some options there for the consumer when making the decisions what's best for them and their family. Okay, I think I'm going to end on this last one because this is one that's like I think the rumor of the week is when it comes to trust. Titling your property in trust, family trust, very common to see that done. And then who the policies in place for. So what happens a lot is people will put their home in a trust, never update the insurance, and the insurance is in the homeowner's name. So the new rumor is if that happens at all, 100% instant denial is what I'm seeing all over social media, which you and I both know is not the case. So I just wanted you to really dive a little bit deeper in how that's managed, what comfort levels people can have if they do have properties titled in a trust, but their insurance might not list that trust on the insurance policy, and where policies can decline and where the coverage obviously would perform as well. So do you want to shed some light on that? Because that, I'm sure you've seen that. It's everywhere. I've had this last week
Yeah.
alone, I think 4 or 5 attorney partners and friends just want clarification and shoot emails over as well. So I've been answering that question a lot this last week or so.
Yeah. So the key to anything is you want to have insurable interest in the home that you own, right? And so insurable interest means that you own it. You have a right to, it's deeded to you. Now, a trust is an extension of you and a lot through this. And depending on the carrier will either have the trust listed first and then the members of the trust as additional insureds, or they'll have the main members of the trust listed as named insureds and then add the trust as an additional insured. So as long as the members of the trust are residing in the household, it becomes a mismatch of deeding. And through a mismatch of deeding, nearly every insurance company is going to simply say, hey, we discovered this. Please provide us documentation and update the named insured so that we can pay this out legally, right? Because they have to pay out the money to the deeded owner of the home. So it's a very quick process. We saw this a lot in the last couple of years with these fires, especially with Fair Plan, because I think they're the most proactive. Well, they'll send it to the agent. They'll also send it to the client and they'll explain that, right? We have a mismatch. Please provide the documentation. Where we have an issue of ownership is that people assume ownership can be passed down. So let's say that, mom had a trust, and in that trust, it named the daughter, and the mom passes away. The daughter moves into the house, and she still has that insurable interest because the trust named her. But then that mom goes, oh, I'm getting married, and I'm going to go live over here. and I'm going to let now my daughter live in here. The daughter's name nowhere in the trust. She's not on the deed. And that is where you start to get those claims denials because there is no insurable interest to fight or to go through or to prove. And so essentially they can deny those claims because it wasn't occupied under the primary occupancy that the contract was written under.
Yeah, that's a great example. So I always recommend, obviously, if you have a trust, make sure you communicate that with your insurance agency or broker, so that way it could be structured correctly. But for the majority, and I'm just going to use a blanket statement, a majority of people that have their personal property in a family living trust, um, there's not going to be this concern of just instant denial that you're seeing, the scare tactics on the social media right now. In most cases, they're still going to be fully covered. So it's just a matter of, like you said, the deed just not matching on the way it's titled. Well, good. Anything else you want to add? I know it's been a horrific start to 2025 for California. I know I can speak on behalf of our entire agency. Our hearts go out to everyone that's dealing with these disasters right now, from homeowners, the community, to the firemen and extended family. It's just we see it often, and it's sad to see all the way around. So our team tries to rise to the occasion the best we can during these times, and this is what we're here for. But yeah, it's just when you couple that with just so much misinformation going out there, I can only imagine how much extra stress it causes to a homeowner, a consumer, when they're already dealing with so much. So, I know you had the same stance. We weren't really proactive out there on the social media channels. We wanted to get all the information correctly before we were misspeaking ourselves. And unfortunately, there was just a lot of information out there that were incorrect. It was incorrect from the very beginning, and it caused a lot of anxiety for the community. So anything you want
Yeah.
to add, Aurora, before we wrap this up?
Yeah, I'd say one of the other things that's out there right now is in regards to fair rental value. And a lot of people and a lot of agents, unfortunately, think that that means that the home has to have been rented out. And so a lot of people will forego this coverage because they don't understand the coverage. And when we're talking specifically about California Fair Plan, that fair rental value is what is going to pay for you to go live elsewhere if you cannot live in the home. And so, as many of you know, I mean, there is some forbearance of mortgages in the first year of a wildfire. But outside of that, when you look at the standard time to rebuild being a minimum of 3 years, if once that year passes, if you don't have fair rental value, then now you're paying for an increased rent because you have pressure in that rental market that's going to cause that to go up. Plus, you have your mortgage, and that's where we see a lot of people end up foreclosing on their mortgage and really
Mhm.
hurting themselves. Fair rental value is the cost per thousand in there for rate is very minimal in your California Fair Plan. And what you want to do is you want to get out there and you want to look and see what your home would rent for currently furnished on the marketplace. Zillow has a Zestimate rent on there. You can talk to a property manager, but you want at least 36 months worth of coverage on there so that you can sustain and make both of those payments when the time comes. In the meantime, if you're not needing it and you're just needing it and your mortgage is basically supplying that, then it doesn't require receipts. So you can use that money how you need it in that interim, but not having it is probably one like being underinsured and not having it at all is a very catastrophic thing for you. And a lot of homeowners, once they realize or that runs out, if they've just chosen like 5 months of it.
Yeah, it puts them in a really tight spot. So that's really, really good point to make. So, well, good. Well, thank you very much for dedicating the time here, Aurora. If you're listening, we hope you found this valuable. I can speak on behalf of Aurora and our entire team here at Sky. We're available for questions, just discussions. If you hear something, you just want to know if it's true or how something would play out. We field those questions all the time, so our door is always open. And I know, Aurora, you mentioned this weekend you might be out in LA actually on the ground helping people as well. So if you
Yeah,
if
it
you do
doesn't. Yeah,
that, just be safe and represent us well, and just give that area a lot of love.
do.
All right. Well, thank you very much.
Thank you.
Bye.